Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 307 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about 3 questions that you need to ask yourself before you ever invest in the stock market. Because I think that a lot of people enter the stock market quite haphazardly. They do so because, they want to grow their money or they don't want to miss out on asset prices increasing or whatever, right? But I don't think they really ask the right questions. And I don't think they ask the questions that are ultimately going to be able to sustain them as investors over a long period of time and make sure that the money that they are putting to work does grow for them and does not just evaporate into thin air like some people's does. So I want to talk about those questions. I want to tell you what those questions are and then give you some of my thoughts on each one. So we can discuss all that and more in today's episode. But before we get started, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to this show on a day-to-day basis. Now, I talk day in and day out about the importance of investing your money. And I talk about, the ways in which you can invest your money. I talk about, the advantages, the disadvantages, the things you should do, the things you shouldn't do, right? But a lot of things that you do when you're investing, or things that you don't do for that matter, they are internal, right? It comes down to your mindset. It comes down to how you have thought about something. It comes down to the way that you have mentally prepared yourself for whatever action you're ultimately going to take, right? And I don't think that today's episode is really any different. I think when it comes to investing, right, there are some questions that we need to run through mentally before we ever get into the stock market, before we ever get into any type of investing. We need to ask ourselves some very important questions, because if we don't do a thorough internal analysis of how we feel about a certain investment, of what that investment is going to do for us, and some of these questions that I'm going to ask today, right, then how are we actually going to know if this is going to be beneficial for us or not, right? It's one thing to look at, the stock market and go, oh, things are booming, it's time to make money, right? And so you go out and you try to make money, and I'm sure many people have tried to do that over the last year and a half or so, right? It's one thing to even look at the market and go, hey, the market just crashed. Let's buy the dip, right? And look, and you want to go and buy the dip in whatever asset it is, right? But again, right, these are questions that you must ask yourself. And I'll preface all of this by saying I ask myself these questions every time I choose to add new money to the market. Right? I've asked myself these questions recently, and I will continue to ask myself these questions as long as I'm an investor and as long as I continue to put money in, because they are the foundation. They are the foundation as to why you invest. They are the foundation as to, if your money's going to grow or not. They're the foundation as to, are we prudently investing or are we just speculating? Okay. So without further ado, I'll just kick off with the first question that you need to ask yourself. And this is a big one. And again, it's very straightforward. It's very self-explanatory, but we need to ask ourselves this question. And this question is, can I afford to lose this money? Now, you may say, well, that's pretty simple. If I'm looking to invest, then of course I can afford to lose that money. Of course I can put that money to work. Why would I, choose to invest if I can't afford to lose this money? Well, this isn't always such a simple question. You may think to yourself, well, hey, what I'm going to invest in, it's not going to be going down in value to zero, so I'm not going to lose all that money. Or you may be thinking to yourself, hey, it's savings that I have. I want to invest it. I'm not going to lose this money given what I'm investing it in. Everything's going to be fine. Look, it's not just a matter of losing everything, right? It's a matter of losing value, and it's a matter of losing money that you actually may have needed, right? I think we should ask ourselves this question for more than just the reason of is it going to go to zero, which I think is still a good question, right? When we talk about losing money, are we investing in something that has a chance of going to zero? But, ultimately, if we have a chance of going to zero, right, and we're going to invest in something, we must think that chance is so low that it can never materialize. Like if you invest in an individual company, of course, that individual company has the chance to go to zero, right? But that doesn't mean that it will ever truly materialize as long as you do your analysis and you do your homework, right? And especially if you buy an index fund, if that goes to zero, then things have gone horrendously wrong, not just in the stock market, but the economy and the world as a whole, right? So when you think about those things, you're like, of course, those aren't going to go to zero in value, right? But what about losing money? Now, you may say, well, I want to stay invested long enough not to lose money, and that is fair, right? That's a fair assessment. You don't want to be a short-term trader. You want to be a long-term investor, and in being a long-term investor, we want to hold things that even though they may go down in value in the short term, over the long term, they will increase in value and create returns for us, right? That's the whole point of long-term investing. But the problem is that a lot of people want to put money to work that they don't have the time to put that money to work adequately, right? You're trying to get yourself some quick gains, right? But there's no telling if you're going to get quick gains or not. In the short term, there's no telling what the stock market or any particular asset within the stock market is actually going to do. Right now, you may look and go, during the coronavirus crash, it's obvious, the a 30% drop and, investing after that 34% drop, whatever it was. And, of course, you're going to make money on the other side, of course. Right. Well, who's to say? Is there anybody that's saying you must make returns on the other side of that? Absolutely not. Is there anybody that's going to say that the market shouldn't go lower? Absolutely not. Is there anybody that's going to say that the market should return to, the level that it was as quickly as it did last year? Absolutely not. Now, it did, and it made a lot of people look very smart, myself included, as far as, making really good returns. But it's not necessarily a shoo-in. It's not necessarily the case that this is going to happen, especially in the short term. Now, when you make moves like that, I'm not saying those are bad moves to make. Those are great moves to make if you are a long-term investor. A 30% drop is a gift to a long-term investor, right? And people try to make that a gift to a short-term speculator. But ultimately, you can get bitten by the fact that you needed that money. Right. And this kind of brings me back to something we've talked about recently when it comes to our emergency funds and our savings that we're going to use. Right. If you can't keep your money in the stock market for an absolute minimum of 3 years, but I like to even say a minimum of 5 years, then you shouldn't be investing the money in the first place. You cannot afford to lose that money. Right. Because you want to spend it on you want to buy a new car. Okay, you're going to need to buy a new car, or you're going to spend it on something specific. You're saving up a down payment for a house, right? Or you need it for your emergency fund. If it's your emergency fund, you cannot afford to lose that money, right? So we don't need to put money in the market, no matter what we put it into, that we have any chance of needing it before that 3 to 5 year period. Now, the reason I say 3 to 5 years, once you get to 5 years, ultimately, there are very few 5-year rolling periods historically that the stock market has been down, right? And if you go out to 10 years, the longer the duration you go on these rolling periods, the less likely you are to lose money, right? Which is not surprising, okay? So I want to make sure that you can stay invested long enough in order to grow your money. I want to make sure that you can stay invested long enough to not lose your money in any major way, right? So, of course, we want to make sure that we never invest more than we're willing to lose, and you need to be mindful of what you're putting at risk. Of course, the risk is not always us losing everything, and the risk is not always, if you're not willing for it to go down in value. That's not the risk. The risk is that we end up needing the money when we've had losses. We end up needing the money when the money is down on its luck, right? And that's not what we ultimately want. So the first question, a big question, can I afford to lose this money? And your answer before you ever invest any of your money should be, yes, I can afford to lose this money, right? Now, again, I want to make sure that we're on the right page. I can afford to lose this money does not mean I can afford for this money to evaporate, okay? That's not what I mean, right? For a long-term investor, can I afford to lose this money means can I afford for this money to go down in value in the short term? And if the answer to that is no, I can't afford to, then you shouldn't invest the money, right? Otherwise, jump right in. Okay, so that's the first question I ask myself that, right? And the way I can ask myself that is I look at my own accounts, mine and my wife's accounts, and go, okay, is there anywhere else that we need this money right now? Is there anywhere else that this money can be useful? Is there anything that we're going to have to pay for? Is there anything that we're thinking about buying? Is there anything that we need to save up for where this money could be put to better immediate use? Am I going to just dig right back in and grab this money in a short period of time? And if I do need the money for anything else, I don't invest it. I put it away in savings, right? And ultimately, yes, I know savings makes very little right now and probably will continue to do so for some time into the future. But we need that money. If you need the money, then the money needs to be in your savings, not with your investments, okay? So that's the first question. The second question is this a great investment? And will this continue to be a great investment into the future? Okay, so this is another weird question to ask yourself, but we need to know the answer. Okay, the reason that we ask ourselves this is because we want to make sure that whatever we invest in, one, we're not tempted to just trade in and out of in the short term, because we know that's not a winning game. It's not a winning game to trade in and out of things over a short period of time, right? And so if something is great and we know it's great, right, and we invest in it because it's great, then we have more of a basis by which we can go about saying, hey, I'm going to stick with this thing. I'm going to invest in this thing. And you can't pull me off of my conviction in that way, right? It may be something that, is as simple as an index fund, right? That has made great returns over a long period of time. Of course, that would be a great investment, right? Or a mutual fund with a long history of great returns, right? That would be a great investment, right? Or a business that you have done the analysis on and you're comfortable with holding over a long period of time once you purchase it. That could also be a great investment. And if it is not a great investment, if it is not a great long-term investment, again, not a short-term speculation, a long-term investment, then we don't need to purchase it. We need to stay away from it. Okay. Even Warren Buffett does his homework before he invests. He looks for long-term value and aims to understand the companies he invests in. Intelligent investing is not complex, though that is far from saying that it's easy, Warren Buffett wrote in his 1996 annual shareholders letter. What an investor needs is the ability to correctly evaluate selected businesses. So if you're investing in individual businesses, you need the ability to correctly evaluate them, right? We don't just need to jump in on what's popular, right? The meme stock craze or Bitcoin or Ethereum or whatever, right? Just because everybody else is doing it doesn't mean it is right for you. Just because you saw a rather successful short squeeze, right? Where, they were buying the shares of AMC and buying the shares of GameStop and pushing the shorts out, thus pushing the price higher, right? Don't confuse that particular situation, something that novel, with something that will repeat itself over and over and over again. And what do we know will repeat itself over and over and over again? Well, as long as the United States remains a world power, as long as we have economic innovation, as long as money is easy to attain, right, then what's going to happen is you're going to continue to see the best of the best in the United States innovate in a way that will create new companies, that will create new technology, that will create shareholder value over a long period of time. And that is what drives me to investing in the S&P 500 all the time, because as long as the United States is going to win as far as innovation, as long as the United States is going to win as far as our ability to create shareholder wealth, then of course you want to be behind that large diversified group of companies. Okay, so ultimately, we do have to ask ourselves, is it great? Is it something great that we can invest in, right? Is it something that does have the ability to be held over a long period of time? Now, this doesn't mean that it has to pan out the exact way that you think it is. Of course, if you're buying individual investments, things can change, right? If you're buying individual stocks, things can change. The story can change, and then you may need to divest, right? But if you're buying an index fund or a great mutual fund over a long period of time, that should be something that you stick with. There shouldn't be a reason to come off of that ideology over a long period of time, unless if it's something like an actively managed mutual fund and you have a sustained time period where you don't keep up with the market. But ultimately, you don't have to worry about that with an index fund because you make what the market makes, right? So is it great? Is it sustainable? Can we invest in it over a long period of time? And if the answer to all of that is yes, then by all means buy. If not, then do not jump in. Now, I ask this to myself. Right, I look at things and I go, is this something that I'm willing to hold for a long period of time? Is this something that I'm interested in? Is it something that, when it comes to individual businesses, is it something I understand? Is it something that I can analyze? And then when it comes to obviously the group investments, the fund investments, is this going to have good long-term value? Is this diversifying me properly? Is this proper asset allocation for me? Is this what I need to meet my risk profile? And if the answer to all those things is yes, then it's great, and I will purchase it. And it doesn't have low expense ratios? Are there low costs associated with buying this fund? All those different things. These are things you have to take into account and make sure that you are investing in something great before you ever just jump into a particular market. Okay, so is it great? Is the second question that you need to ask yourself, and then is it suitable? Is the last question? Is the third question, right? You need to ask yourself: is it suitable? Does it fit with my overall investment strategy? Is it something that is suitable for me to invest in, right? We need to consider how investing in a particular stock or a particular investment relates to your overall investment strategy, right? You don't want to risk more than you're willing to lose, but also understand how much you're putting in individual investments relative to the other parts of your portfolio, right? You want to make sure that your portfolio meets, like I've said before, and I said a moment ago, your risk profile. You want to make sure that your portfolio meets exactly what your needs are over the long period of time. And if it does not, then you need to rethink what's going on in your portfolio. Now, while this allocation depends on investors' personal circumstances and can vary, right? You want to make sure that you do have proper diversification. You want to make sure that you do have proper asset allocation for where you're at. And as I told you before, proper does not mean that it can be standardized. It does not mean that everybody of a certain age needs to have a certain asset allocation, or everybody who is at a particular part of their life, like retirement, needs to invest in the same way. It's just not true, right? Everybody has different needs. Everybody has different wants, and those need to play into your portfolio and ultimately what you do with your money over a long period of time. Now, whether you're talking about individual stock picking or investing in large asset classes that you're researching, or you feel like there's an opportunity to make money in, you want to make sure that you are allocating the proper amounts to the proper places in your portfolio so it doesn't all just blow up in your face, right? Ultimately, you want to decrease the correlation of returns if you're looking to diversify or have some proper asset allocation. You don't want everything moving in the same way over the same period of time, right? You want some balance to your portfolio, and maybe you don't want balance to your portfolio, and that's not what you need over a long period of time. And guess what? That's perfectly fine, but you have to be well aware and self-aware that that's not the case with you, and you have to know where your money's going and be okay with it and see how it fits in with the rest of your strategy. Because it's one thing, right, to be an index fund investor and invest in the S&P 500 over a long period of time, or bond indexes or whatever, right? But it's another to be doing that and then see that GameStop is blowing up in price and decide you're going to buy shares of GameStop. That just doesn't make any sense. That's not part of your strategy. That's not part of what you're doing. I would add to this that we don't need to think of strategy as just investment strategy. We need to think of this as your financial strategy as a whole. All right, we need to think of this holistically, because investing is not done in a nutshell. It's not done in a vacuum. It's done as a part of your greater financial plan. And, I talk about the financial action plan all the time, right? So the question I ask is it proper as a part of your financial strategy, right? Should we actually be investing at this point? Should we be investing in these types of things at this point? Right? Should we be speculating this much? Should we be, putting our money into things that we, aren't prepared to do so, right? It's very important that we understand our priorities with our money. Right? It's very important that we understand what comes first, what comes second, and so on. That's why the financial action plan is so important. That's why a financial plan that is organized is so important, because you need to know what's going to happen in your financial life step after step after step. And we don't need to decide, hey, the stock market just crashed. And a lot of people did this. Mind you, a lot of people did this last year. They said, oh, the market crashed. It's a perfect time to go in and try to buy things. And so what did they do? They went in and tried to buy things with their stimulus checks and whatever, right? When they could have been using their money, using their stimulus checks, using whatever else in order to help them get out of debt. right? In order to help them have some emergency savings, because that's what the stimulus check was for in the first place, right? It's for being able to deal with an emergency situation, right? So they could have built up some emergency savings, right? They could have done any number of things with that money in order to shore up their financial foundation, and many of them put it to work in the market. And I'm not saying that nobody should have put it to work in the market, because I did with a fair amount of my own stimulus check. But what I'm saying is I was in the position to do so, right? I was in the position to put that money to work in that way. But if you're not in that position, you shouldn't be doing that, because it's not a part of your strategy, right? You need to stick to your strategy. Don't let a specific time in the market, a specific event change your strategy, because it should not, right? The strategy is at least what I say that you should do, what I think you should do. They hold based on the test of time. They hold based on the test of pretty major events, right? So we need to make sure that we do them properly and do them in the right order, and don't stray from any plan that you have. Ultimately, something like the financial action plan, somewhere that somebody could have done this and strayed from this plan, is if they were in the third part where they're investing in their 401k and getting the employer match, and then saw that the market dropped and go, oh, well, let me buy some more now. Let me invest some more to take advantage of this. Or if the market's going up real strong and they think they can they can benefit from that. Oh, let me invest some more now because everything's doing so well, instead of just sticking to the amount up to the match. That's taking away your ability to shore up your financial foundation. That's taking away your ability to get out of debt. That's taking away your ability to build up an emergency fund over a long period of time, right? And that's what we need. We need a strong financial foundation. That's the thing. You need a strong financial foundation, right? That's the baseline. You need that, right? But we want a financially free life. And that is everything after we build up an emergency fund, get out of debt, and begin with just taking the match in our investing, right? So ultimately, right, we want to make sure that what we're doing is best and it's going to fit into our lives, it's going to fit into our strategy, right? And it's not going to take away our ability to do what we want to do or what us and our spouse are choosing to do in our financial lives. Because the reason that you may think about this is because you could put money into a IRA account, right? Or Roth IRA or whatever, right? And that money you can't access until you're age 59 and a half without penalty. And you may be thinking, okay, well, if I put a ton of money in there, if I'm putting a lot of money there and there's no way to access it, I can't access it until I'm 59 and a half other than just my contributions, right? But if I want everything out of there, I can't get it until I'm 59 and a half. And I'm just loading this thing up, putting a bunch of money into it, right? That's perfectly fine. But if you don't have liquid money to do the things that you need to do otherwise, right? If you don't have money that, let's say you're trying to save for your kid's college, a Roth IRA might not be the place to do that. Or let's say you're trying to, invest some money so you can put a down payment on a house at some point. Then a Roth IRA might not be a place to do that, right? It does not fit. It does not fit in that place. Your money doesn't fit in that place. So you need to make sure that wherever you allocate it does fit into your life, does fit into your overall financial strategy, your overall financial picture, and then you'll be better off over a longer period of time. Look, none of these three questions are hard, right? But all of these three questions must be examined before we ever put money into the market, especially to do so for the first time. Right? Because the first time seems to be the time where we are most haphazard with our money. It seems, and maybe that shouldn't be. Maybe it should be the opposite. But I think that first time is when you need to invest. Maybe it's a good time to invest or something, right? And you're just gonna go for it, right? Just go for it now. Do it now. Do it now. Do it now. Right? There's not a whole lot of chill to it. There's not a whole lot of reserved nature of the investor. Ultimately, it's like a do it now type thing. And I don't want it to be that way for you. I want you to be chill. I want you to be relaxed. I want you to make this decision based on the answers that you have to these questions. I want you to know without a doubt that this money you're putting away is money that you should be putting away to invest over a long period of time. I want you to be able to answer, yes, I can afford to lose this money. I can't afford for this money to not be spendable right now, right? I can afford to do that. this is a great investment. It's either time tested, as a fund, or it's, got really good fundamentals right now. I've analyzed it. I know what it's worth. I know what it's about. I know what it does, if it's a specific company. And I know that this is a great business. I know that this is a great investment. And so I know that investing in this thing is not going to end up with me having $0. Right? And then I know that this fits into my investment strategy. I know that this fits my risk profile. I know this fits what I'm doing investment wise, right? I know this fits with my greater financial strategy, my greater financial plan. And if all those things add up and you say yes to all those things, then jump in, invest, do what you're wanting to do with that money, right? But if you fail to think through those things, right, then where can that lead you? And that's what I want to kind of leave you with today. Where can it leave you if you fail to answer these questions in those particular ways? Well, if you can't afford to lose the money, right, then obviously that's a problem, because that could leave you in a position where you're going to have to go into debt to pay for emergencies because you invested your emergency fund and lost it, or it's going to put you in a position where you're not going to have as much money as you thought you would because you lost some. And let's say it was your down payment for a house, or the money you were going to use to buy a car, right? And the money went down in value. Now you don't have enough to do those things, right? That's what happens when you incorrectly answer that particular question. Then what about it being a great investment? What happens there? Well, your returns fall short, right? Your returns ultimately are going to fall short. Not only are your returns going to fall short, if you don't know about the investment that you're getting into, if you don't understand what you're investing, if you don't know what you own, like Peter Lynch always said, right? Know what you own, then it's going to be difficult to actually hold on to that investment. It's going to be difficult to watch it drop in value, which all individual stocks do from time to time, drop in value and not sell out. It's going to be difficult to watch it fluctuate, even if it's a fund, right, and not sell out. Or it's going to be difficult to watch a fund, maybe an active fund, underperform the market, right? And maybe you don't have something that is, fully stocks. Maybe you're in some type of balance fund. It's not going to be easy to watch that fund underperform the stock market as a whole, and you'll be looking and going, oh, well, maybe I should be in the market, not taking into account that things need to match your investment strategy, which brings me to, if you don't answer that question correctly, if something doesn't fit your investment strategy or your financial strategy, where does that leave you, right? That may leave you in a position where you just don't have the money to do the things you need to do, right? You have to go deeper into debt. You don't have an emergency fund. You're investing in a way that doesn't match your risk profile. So you're going to do a lot of unnecessary buying and selling. You're going to be very fidgety. You're not really going to understand as well, right? You need to know how something fits into your strategy and be clear about how you're going to invest over a long period of time. And a long period of time doesn't mean a year. And a long period of time doesn't mean 2 years. A long period of time means 10 years, 15, 30, 40 years, right? And you may say, oh, well, I'm in my 50s. I don't have that long. If you're in your 50s, you have statistically until about 80 plus, right? So you've got at least another 30 years to invest. Think that way. Don't think till retirement. Think until I don't need this money anymore. Think till this money is no longer within my management. That's how long your time horizon needs to go. So ultimately, answer these 3 questions. And if you answer them properly, go ahead, invest in the stock market. If you don't, then rethink what you're doing and get to the point where you can answer these questions correctly, because we all need to be investing and we all need to be effective at doing so in order to grow our money over a long period of time. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to the show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.